Ladies and gentlemen, welcome to the June 2013 fourth quarter webcast for Cadence Capital Limited. As always, I'd like to start just going through the year's performance. The fund was up about 22% against the All Ords Accumulation Index, which was up 20% roughly. So we've outperformed by about 1.5% this year. I think the pleasing thing about this year is that the All Ords has actually had a very good year. Since we've been running funds, the All Ords has been up about 5% per annum, and at least this year it's had a 20% year. The first slide also shows our exposure for the year, and on average indicates that we've held around 20 to 25% cash during the year. People that receive our newsletter would be used to seeing these two charts, and I would encourage people, if they would like to get this information, to join the monthly newsletter. The following slide shows the sector and stock performances that have done well and the areas that have done poorly for us. Australian New Zealand Bank, the BlueScope Steel Limited, Bravura Solutions Limited, Flexi Group Limited, Macquarie Group Limited, Macmillan Shakespeare, QBE and RHG Limited are some of the stocks that have done well for us. And stocks that did poorly for the fund are Arium, Bathurst Resources Limited and Coffee International Limited. The sectors that did well: banks, diversified financial, software and services, commercial and professional services, and the sectors that did poorly: materials and capital goods. In actual fact, interest rate sensitive stocks did well and materials did very, very poorly. The following slide also appears in our monthly newsletters and shows our dividends since listing. We've paid out 49.2 cents of dividends since listing and 69.4 cents of grossed up fully franked dividends during that period. The board declared a 5-cent final dividend for Cadence Capital Limited shareholders, payable on the 30th of September 2013. That brings dividends for the year to 11 cents, and on our closing share price on the 30th of June 2013 of $1.30, that's an 8.5% fully franked yield, and one of the highest yields in the listed investment company space in Australia. Turning now to the year in review, and we've done that this year in charts because it has been a very, very interesting year. The first chart shows the All Ordinaries Accumulation Index, which we've already said was up about 20%. A very, very good year for the All Ordinaries Accumulation Index. The chart after that shows that the Materials Index again had a very, very poor year, and since resources rolled over around 3 years ago, really the trend has been down, and that trend continued in the year just gone. The next slide is an interesting one. The Small Ordinaries Accumulation Index actually rolled over this year. It has performed, since we've been running funds for around 9 years, actually has had a reasonably good performance, but in this year actually rolled over and was down 5% for the year. I've contrasted that on the following slide with the Russell 2000, which is, I'm trying to get an equivalent measure in America of the top the first 2,000 stocks by market capitalization in America, and they had a fantastic year, as did the S&P top 500 stocks in America. So whilst our All Ords did well and our Small Ords did poorly, overseas both small and large caps did well. The final slide that is trying to show some breakdown of the index is the gold price in Australian dollars. And again, we've seen that the gold price in Australian dollars has rolled over as well. So quite a diversified year in terms of performance of the All Ordinary Accumulation Index. And what can we say about that? Well, in summary, it was a volatile year, and surprisingly, 80% of the performance for the year came from 5 stocks: the 4 major banks and Telstra. These are all stocks that have a good dividend yield, and it could be argued that these dividend yielding stocks have re-rated. But the issue for us now is that many of these stocks, on a price to earnings ratio basis, a price to book basis, a operating cash flow and free cash flow yield basis, are no longer particularly cheap. And that does create a dilemma for holders of these stocks ultimately, and we'll come on to why that is. In the outlook, as always, the last year was a volatile and uncertain one, but investment opportunities presented, and we think that the year ahead is going to be a similar year to that. The concept of looking at bottom-up analysis and detailed stock-by-stock analysis has worked for us, and it is our investment philosophy, and we will continue to do that. To try and predict where the overall market has gone or is going to go in the year ahead is very, very difficult, and as we've just illustrated in these charts, the market is made up of very, very different sectors that are performing and have very different performance dynamics at the moment, and so we see that for the way that we invest money as really a futile exercise. It really is a stock-by-stock analysis that's important. And we believe that the battle in the year ahead will be half won if we can avoid poor stocks and can look for quality cash flow stories with strong operating cash flow yield. Well, whilst that seems a reasonably obvious statement to make, it is important in this environment to have an open mandate to be able to choose stocks that are operating, that are good, and not be forced into underperforming sectors. For example, being forced to buy resources, or being forced to be 25% in small capitalization stocks, or have a very, very restrictive mandate. In this environment, you really do need an open mandate and the ability to pick from a wide number of stocks, because the number of stocks that have actually done well in the year just gone is really not a very big percentage of the overall portfolio. It looks like low interest rates are here to stay for the time being. We've just had another interest rate cut by the Reserve Bank of Australia, and that really just perpetuates the dividend chasing story and the bond bubble story. And of course, the lower interest rates go, the higher these dividend yielding stocks will go and the higher bond prices will go. Of course, the final point to make on that is just like the resources boom ended 3 years ago, and just like the small ordinaries index boom appears to have rolled over this year, so eventually the index, the industry sensitive index, or interest rate sensitive assets will roll over as well. That's a point to be mindful of. We're not predicting that this is the year that that's going to happen, but certainly at some stage interest rates will start to go up, and these particular sectors will not perform well in that environment. Ladies and gentlemen, since preparing these slides, we have also announced that a Pepper scheme in which Cadence is assisting Pepper in buying 100% of the assets of RHG. And as a consequence of that transaction, we will actually be submitting an additional webcast over the next few days, and we'd encourage people to look at our website over the next few days, subscribe for our newsletter, and also be ready to see the second part of this webcast, which really will focus in on our largest investment, which is RHG Limited. Thanks very much for your time, and we look forward to being in contact with everyone again, and particularly meeting everyone again at this year's annual general meeting. Thank you.